I would like to call up at this point our guest speakers, Mindy Eisenberg Stark. You can come up to the dais here. George Hanis. Jonathan Shalik. Jonathan Shalik. A couple more. John Unterreiner. John? And Philip Weiden, Worcester, HGAR, Hudson, the order of this program tonight, I guess I would like to start out, if I may, ladies first. That's my first rule of order. But also because we had the pleasure of having Mindy a couple of months ago, as I recall, and this was when the whole tax, to use an old Neapolitan phrase, this whole tax hazardai going on in Washington was just beginning to kind of take shape, and what we were hearing certainly was not good for the industry as a whole. And Mindy, I remember distinctly, Mindy, you commenting on it for a few moments with what we knew at the time, and said that it did not bode well, certainly for cooperative corporations. Since she was kind of like the first one out of the gate to give us a fairly ominous prognostication, I thought we would start with the bad news first, and start with the effects on co-ops and condos. As we have a lot of representatives here this evening, we'll be anxious to hear what the assessment is. So please welcome the distributor of Bloom and Doom, Mindy Eisenberg.
Good evening. I hope I don't bore you all to tears, because taxes is certainly never an exhilarating topic, and you have 3 accountants here this evening. Lucky you. So my name is Mindy Eisenberg Stark. I am a certified public accountant. I am a certified fraud examiner, and my firm audits approximately 100 co-ops and condos in the New York metropolitan area. So I come to you with both the tax side and the co-op and condo side. So in focusing on the co-op and condo piece, and I guess real estate in general, one of the major elements of the new tax act that is going to have an impact is the limitation on the mortgage interest deduction, as well as the limitations on the real estate tax deduction. So basically, Trump really socked it to the blue states along the coasts, because as you're all aware, we have probably the highest real estate taxes and state and local taxes in the United States. And basically what they've decided to do in their infinite wisdom is, starting with 2018, there is going to be, in terms of itemized deductions, a limit of $10,000 as a combination of state and local taxes and real estate taxes on the personal income tax return. Now this does not have anything to do with real estate investment or people who are operating real estate as a business. This is strictly on the personal income tax return. You will have to take the combination of the two, and you're limited to $10,000. The other element is that what they have done is that while previously you were allowed to deduct mortgage interest on mortgage's acquisition debt of $1 million plus $100,000 of improvements on any new real estate acquisitions, it will be a $750,000 limitation. So those who own co-ops on Park Avenue or in some of the higher rent districts, basically if they are purchasing high-end real estate properties, they are going to be limited in those deductions as well. So what does this all mean? So first off, anyone who is in alternative minimum tax, or is AMT as it's most commonly referred to, they will not be affected by these new rules because under the AMT, basically your real estate tax deductions did not really benefit you from a tax standpoint because they weren't add back from alternative minimum taxes. What's going to happen as a result of this is we're going to find more and more individuals who are going to be taking the standard deductions on their tax returns because a lot of people, their largest deduction was their real estate taxes and their state and local income taxes. So they've raised the standard deduction on a joint return to $24,000 and they limited these deductions. So number one, what are the states doing about it? And number two is what does this mean for the real estate industry? So I saw an interesting article today in that the states who are hardest hit by this are trying to come up with creative ways to change the terminology of the state and local tax and the real estate tax so that it would fall under the new federal tax code. Well, let me just step back 1 second. So the last 2-3 weeks of December were absolutely bedlam in our office because everyone was calling to find out whether or not they should prepay as much as they could of their real estate taxes in anticipation of losing that deduction. So obviously the first problem was the individuals who escrowed with a bank because the banks were not willing to prepay because the escrow accounts were not sufficient to enable them to prepay. And then it became a whole question of what taxes were being warranted by the municipalities because you could only take a deduction if in fact it was warranted, and Westchester County couldn't get it done on time because of the budget and Astorino going out of office. So those that could did, but with regard to the co-ops, it was a major issue. And the reason it was a major issue is that the financial statements of the co-ops are done on an accrual basis. What that means is that if you prepay taxes, you can't deduct them. They're shown as prepaid taxes on your financial statement. So unless a co-op was going to be willing to elect a change of accounting method for their tax returns, they were not going to be able to take these deductions anyway. So we got so many calls from management companies and from co-op boards trying to make decisions about whether or not it was worthwhile to go through the whole change in accounting method in order to basically be able to get 5 quarters or 6 quarters of deductions as opposed to the 4 in anticipation of this one-time ability to load up those deductions. Our answer, based on all of our discussions with management and with the professionals in the industry, was we were not recommending it because of the whole concept of having to change accounting bases, as well as the fact that if the IRS were to audit it, we as professionals would be on the hook for every single shareholder in those buildings having to amend their own personal tax returns. So it really was opening up a whole can of worms. But we passed that crisis, now we're in 2018. So what some of the states are looking to try and do is, I actually read that they're trying to get state and local taxes or real estate taxes to be reclassified as charitable giving to the states. So that, in fact, they will be able to recategorize it instead of taxes, to recategorize it as charity, which has not as yet been touched by the federal tax. The other thing is to try and change the withholding and personal income tax to perhaps a reduction of wages and let the employers take it as a business tax deduction. So again, your net check will be the same, but you won't have to deal with the concept of the state and local income tax. And then, of course, there are those states that are right now preparing to sue the federal government because they believe that the blue states on the coast have been discriminated against, and they believe that it's unfair. So it'll be interesting to see what happens over the next few months in terms of these deductions. Now, in terms of real estate values, I, as an accountant, am posed with the following question many, many times. Should I buy a house or should I invest in a co-op or condo because I know that I'll do better on my income taxes than if I just rent? Because if I rent, I'm throwing money out the window because I don't get any deduction for the rent that I pay. Well, now that is not going to be as clear cut as it used to be, because since the deductions are severely limited, and probably most people in New York, their withholding taxes will basically hit that $10,000 mark. Other than the interest, there's not going to be as much incentive to invest in property as opposed to rent property. So the question, it will be interesting to see what happens to real estate values for those individuals who would be just as happy to rent as they would be to buy. Clearly, if it's, the difference between having your own home and living in an apartment, I usually try and tell people it's a lifestyle decision and not as much a tax decision. But I think under the new tax rules, a lot of that is really going to, boil down to a lifestyle decision and not as much of a tax decision. So that's the effects that I see as of this point. Thank you.
I know it was mostly bad news, but she makes it sound, palatable with such a sweet voice and a friendly demeanor. Our next speaker, and again, this is purely random here. Our next speaker, George Hanis, who is Senior Vice President of Wealth Management with UBS, will be talking about, some of the implications, I guess, regarding personal wealth management that he sees. In fact, I don't even know what I'm doing here regarding personal wealth management. But anyway, he'll talk about some of the implications he sees on that score regarding the tax changes. George?
Okay, thank you. Albert's fingerprints are all over the title of this meeting. I'm seeing this as The Good, the Bad, and the Ugly. And does anybody remember that movie? Good, the Bad, and the Ugly. Sergio Leone, Albert, 1966. So I am going to be playing the part of the good, which is Clint Eastwood. Unfortunately, Mindy had to play partially the bad, and none of us are playing the ugly up here, okay? So I'm going to start with that. Basically, it's from the tax standpoint, for the equity markets, the stock market, this is very positive. We haven't had major tax legislation in over 30 years. 1986 was the last major tax legislation. Whether you like it or not, as far as the stock market is concerned, this is going to increase earnings. We're looking at rates going down to 21% for corporations, and this is going to translate into increased gross domestic product growth in our country. We're already seeing this in terms of the stock market. We've had a good stock market for quite a while. We at UBS think that only about half of these, the impact of these tax cuts are already in the market. So we think there's more room to grow here. We're looking for earnings of the top 500 companies to grow basically 15% in 2018. And that, to us, translates into a price target for the Standard & Poor's 500 of somewhere about $2,900, $2,950, which is kind of high single-digit increase for the year. We are looking at this expanding our debt and to the tune of roughly $1 trillion. It sounds like a lot. It is a lot. It's real dollars, but the way that most economists look at debt is as a percentage of our gross domestic product. And right now, it's probably going to add only about 5% to our debt load, which in the scheme of things is not tremendous. So we don't see that necessarily as an issue going forward. The other thing is what's going to happen to interest rates, because we're going to see increased economic activity. The Federal Reserve has already started raising interest rates. The federal funds rate, which is a short-term interest rate, is at 1.5% right now, and we're looking for 2 increases in 2018 and 3 in 2019. We don't think, though, interest rates are going to go up dramatically on the longer end, and there's a lot of reasons for that, because a lot of countries around the world, interest rates are still relatively low. If you go to Germany and you buy a 10-year treasury bond right now, you get 0.5% in interest. You buy a 10-year treasury in the United States, you get 2.5%. So we still think there's going to be increased and sustainable demand for U.S. treasuries. So I think we think that'll keep a cap on interest rates. Municipal bonds. This is a very attractive, continues to be very attractive for most high tax income bracket investors, because the top rate dropped on a federal from 39 to 37, so there's not going to be much change there in terms of the favorability of owning municipal bonds. In addition, as Mindy pointed out, most high taxpayers are going to lose a lot of their deductions. They're going to lose most of their state tax, their local taxes, etc. So municipal bonds may be even more attractive to those folks as a tax haven. So that's kind of just a snapshot of where we see the impact to the equity, the bond markets going forward. I wanted to just touch on a couple of, because I'm a certified financial planner and I work with individuals, so I want to talk about a couple of strategies based on the changes in the tax law that might be advantageous to perhaps consider or talk to your advisor about. One of the items, as Mindy mentioned as well, is charitable deductions. They haven't gone away in terms of the ability to deduct them, but because the standard deduction is now 24%, 24,000 rather, a lot of people are not going to itemize. So what does that do? You may lose the ability to deduct your charitable deduction. So one of the strategies I recommend for clients, if you know that you're going to be giving money for, your church, your synagogue, your alma mater, or a charity that you feel strongly about, and you give the same amount over years, you can accelerate that into 1 year. You plan it and you say to them, look, I'm going to give you 5 years worth of deductions now, and that'll help you because then you can itemize, you'd be well over the 24,000. If you don't want to do it that way, the other approach is to use what's called a donor advised fund. Is anybody familiar with that? You use that? It's kind of like a charitable savings account. You put money into it, you get an immediate deduction for it, and you control when the the recipients receive their donation. So if you're giving $5,000 a year and you plan on, I'm going to do this for the next 10 years, you can pick a year and put $50,000 into this charitable fund, and then instruct them every year to make donations to your charity of your choice, as long as they're a legitimate 501c3. So what you've accomplished is you have the ability to take this big deduction in 1 year, as opposed to losing it because of the standard deduction being increased. So that's one strategy. The other one is college savings plans, 529 plans. This is a federal program which allows you to put money into a plan. It grows tax deferred. If you use it for qualified college, you pay no taxes on it. So it's a great way to save for college. And also in New York State, you get a credit against your state taxes. So it's a great program. What's changed now for 2018 and makes them even more favorable or advantageous is that you can now use the funds for elementary or secondary school up to $10,000 per year. So if you're paying a private school, a parochial school tuition now, you're able to withdraw $10,000, pay no taxes on it, which you could never do before. So I think 529 plans will be a big integral part of people's planning. The last thing I wanted to touch on was estate taxes. The federal exemption was about $5.2 million, and it now more than doubled. It's about $11.2 million now. So most people are not going to be bothered by that, but there are affected by that. But there are a lot of high net worth individuals who might want to take it upon themselves now to consider gifting, moving assets out of their estate, because in 2026, unless the legislation, new tax laws are extended, it will revert back, it will sunset, correct, back to roughly $2 million. So I foresee a scenario that if somebody is on life support in 2025, and the person who has the healthcare proxy is the beneficiary, they're going down. That plug's getting pulled, because if the tax law doesn't get extended, they're going to be out some serious money. So be careful depending on what side of the coin you are on that. Be forewarned. Yeah, George Steinbrenner, yeah. And the thing which is also important is that even if the law, according to what the tax law says now, even if it goes back to the 5.2 million and you've gifted up to the 11.2, they're not going to claw that back to you, say you couldn't have done that. So again, great opportunity if it works in your financial plan and in your thinking. Transfer assets outside your estate, they grow outside your estate so they're not taxed at your death. And the last thing I'll mention, just as I said, is municipals. From an investment standpoint, I think they make a lot of sense because of the ability to receive tax-free income, and a lot of these opportunities in terms of the itemized deductions are going away. So that's it in a nutshell, and again, that's the good news. Thank you.
Of course, you know, the worst thing that George could have done was to start with quoting the film. And a little bit of trivia, Clint Eastwood was not originally supposed to be cast in that movie. It was supposed to be, and I'm dating myself, and only a few people know who I'm talking about, it was supposed to be Steve Reeves, who was the original Hercules, who was going to be in the spaghetti westerns, but he passed on it. Probably not one of his better decisions.
Superman.
Steve Reeves is not Superman.
Oh, no?
George Reeves.
George Reeves, okay.
Our next speaker, getting back to business,
Stand correct.
is our colleague from the Hudson Gateway Association of Realtors, who was here tonight to kind of round out the picture, not only on the residential side, which I think was, that discussion was already started, but also on the commercial side. Philip Weiden is the Director of Community Affairs for HGAR, for the Hudson Gateway Association of Realtors. And oh, by the way, I was a little remiss, not only do we have Philip Weiden here, but we have the 2018 President of HGAR, Barry Kramer. Would you mind just saying goodbye? I'm sorry for the oversight. Being the Director of Government Affairs, Mr. Weiden is really on the front lines dealing with all levels of government and government issues. So without further ado, we call him up to give us maybe some mixed news on both commercial and residential real estate. Philip?
Good evening. Thanks, everyone. So it's been interesting this last year. It's been interesting times, interesting elections. I can comment not only on the taxes stuff, but I can also try to comment and give some context to what went on behind the scenes. I've worked in plenty of local governments, and I worked in Congress, so I sort of see the back and forth and what goes on. We'll start with the commercial. We'll start with the good news. They said start with the bad. Usually you say start with the bad, but I'll start with the good. Commercial fared well in this. We kept capital gains advantages, and we kept 1031 like-kind exchanges, which, if you know, allows you to defer your taxes and facilitates redevelopment deals. So that we really, really thought, I think, over the last few years that we were going to lose the 1031 deferral for like-kind exchanges. So that really helps downtown areas. It helps the small businessmen. It really helps people who are trying to revitalize and keep people in that community. So we are very happy about that. The other one, which the other issue with commercial, which doesn't get a lot of coverage, but it's not popular, but for us it matters, and for you, if you're commercial building owners and builders, it matters, is internet tax fairness. We actually right now face a competitive disadvantage because on Amazon, if you buy a product, you face a huge disadvantage if you're a local store, you have to pay sales tax. Online, you don't have to pay the online sales tax because they banned it. They haven't allowed New York and many other states to levy the same amount of taxes. We're not talking about higher taxes than the local rate, but the taxes in that state, putting that small business at a disadvantage because Amazon can get away without having to charge their customers what the local mom and pop shop or even the big box local stores would normally charge. And we think it's only fair that they all pay the same rate, not that an online retailer gets an advantage over a local brick and mortar store. So that's some mixed news on the commercial front. The commercial real estate market has improved, but I'm also going to get on, we cover commercial, but we also cover primarily also residential, and I want to talk about a few things. Property taxes are lower than many years ago, actually, if you adjusted for inflation. So, because of the property tax cap, we help spearhead the effort on that, the 2% or the rate of inflation, whichever is less. That's what tax increases are held to. A lot of people are for it or against it. We felt it was a good positive step to keep the growth of property taxes in check. Obviously, you can't do that anymore. On the state level, David Carlucci now, the good news is, has a bill, if we could pass that, Senator David Carlucci from Rockland County has a bill to allow you to deduct property taxes on your state taxes. So you could use the property tax deduction at least at the state level. So I'm hoping that can get through, hoping that gains some traction. Pete King and Anita Lowy have a bill also to reinstate the state and local deduction for state and local property taxes back to the level at which it was. There's no such thing as anything permanent in Washington. When they say on the business side that it's permanent and on the individual side it's 2025, it's only a tax cut until the next Congress and the next administration come in, and they can change that. So that's what I want to hand people. This is going to be, I think, devastating to state government. We're facing a $4.4 billion deficit this year. So debt at government levels matters. We've heard for 10 years, or really 20 years, that debts are not a big deal. Each party says the deficit's not a big deal, and then the debt goes up, and the next party comes in and blames the other political party for blowing up the debt. I'd say the debt may not be a big deal when times are bad, but the problem is now, this is, in my opinion, is not really the right time to do this. The right time to do a massive tax cut is when unemployment's at 10%. That's when you want to do a massive tax cut. If you look at economists say, pretty much for both sides of the aisle say, now when unemployment's almost at basically full employment at 4.1%, it's the wrong time to do this. People are making more money. Giving them a tax cut now is not really going to create jobs. It's more likely to create inflation, and interest rates are going to dampen the effect. So not only are you taking away these interest deductions, which help people save for a house, which help people contribute to home ownership, by taking this away, rates are going to go up and dampen the effect of the stimulus. So that's also not being talked about. We've had rates of near zero for 10 years. They can only go up. When things are at zero, the only way they can go is up. So I think that's going to dampen the effect. A couple other things. The personal exemption. One thing we didn't mention, the personal exemption has been eliminated. So say you take that standard deduction. For singles, it went to $12,000. For married couples, it went to $24,000. Great, sounds fantastic, except when you take away that personal exemption, that's $4,200 a filer for a tax filer or your child that you could have taken away. So you couple taking away $8,200 potentially for a child and another dependent, on top of taking away their homeowner deductions, you're making out a lot worse off than you were if you had left at least a personal exemption in there. So there's a lot of ifs to this. If you're a single person who's 24, you have a reasonably good salary and you're renting, you're probably going to do pretty well in this for a few years. You'll probably get a tax cut. But if you're trying to save for a house and you're trying to put money away, then it's not good for you. Home ownership has been stuck at around 62%. The national home ownership rate for a while now, since the collapse. That's not healthy. We want to be at about 66, 67. We don't want to be at 75 because clearly we've been giving homes away. But it should be higher than it is now. New York only has about a 52 to 54% home ownership rate. So you're taking this away at exactly the wrong time. So that's a big part of it. I'd also go into a few other things that we haven't covered. Loopholes we've closed off. We've talked about the debt. We've talked about the personal exemption. We haven't talked about the tax shelters. we quote unquote, they call this tax reform, but I wouldn't call this tax reform. I would call this tax cuts and tinkering with some other things. One, they said they wanted to cut taxes, but they only really lowered it each rate by a few points. We're not talking about an extra $5,000 or $6,000. You're talking about maybe 2 points to top rate, which they said if you cut it, that you'll have significant savings. They lowered it from about 39.6 to 37. That's not a massive cut. That's essentially what, a few years ago, the governor did sort of an income, what he called a middle income tax cut, that was about a point or 0.5% over 10 years. That's not something that's then going to go out and say, wow, I got an extra few $100 and I'm going to go down and buy another property. That's not really going to give you the money that you need. So that's a key thing to focus on. A lot of people now are going to be going into what are called LLCs and pass-through income. So you have a lot of people that are super wealthy that are going to just be doing fine. This is not an attack on the wealthy, but in terms of savings, they're now going to be able to switch to LLCs and use their property, which they're doing where I live on Long Island in the Hamptons, as rental properties. So they're going to count that and they're going to get a windfall. So for them, it's going to be okay. Either way, there's always a shift. So tax shelters for real estate, for developers, are going to do fine in this. So they're getting a windfall in the new bill. They're getting a huge break by the people, the first-time buyer doesn't have the savings. We're not addressing student debt, which is a long-term concern. We have people buried in debt with $100,000, $150,000 debts coming out. And unless they work for the government or the armed forces, they're not getting a reduction in that debt. And so we're not seeing a lot of home sales from new buyers. We see, if you've seen from NAR real estate data, we've seen the number of actually single-family homes are now being rented. Renters are going up. So you're seeing a lot of new single-family homes because a lot of Wall Street firms bought up homes when the market crashed. So what we want to see is new home buyers, keep those deductions in place, and see more housing built at the local level. This local inhibition against building, I think we all agree, it drives up home prices also. But if you take away those deductions, unlike the stock market, real estate, it kind of helps. It's forced savings. I'm not an expert on investing in the stock market. If you came up to me and told me what stock to buy, I'd say, go ask him. He knows what he's talking about. I don't know in terms of the stock market what's a good investment. But I know from the long term, I know from my father-in-law who has a mortgage company, that real estate is considered, in a way, forced savings, the part of which I probably wouldn't be doing on the stock level. And most Americans do not own stocks. Most Americans do not own stocks in the stock market. That's the other thing to think of. The stock market is great. It can be a great investment. But most people, the majority, whereas they want to save for a home, the majority aren't saying, I want to save to buy a stock of Amazon in 5 years or 10 years down the road. So I think we're facing a lot of headwinds. I think it's highly dangerous what Congress did. I also think it was highly unfair to do this all in 6 weeks with no input. There was one hearing the entire time. I can comment on the political context. It doesn't really matter to me at the end of the day. We can all laugh what side of the aisle you're on. When I worked in Congress, we actually did hearings and took time to hash out details. And then we gave a lag time, for instance, a year to kick in, or 2 years, to allow people to adjust and not do this and force people online at a local government office and have done, hundreds of people waiting to prepay their taxes this year so they don't get hit. I've never seen a worse legislative process than this law. Whether you come out ahead or not, the process by which this was done, they didn't get input from this. They literally kept this secret so that the home builders, the National Association of Home Builders, and our organization, the National Association of Realtors that I represent locally, they kept this secret so that we couldn't even comment on it. They call us, quote unquote, lobbyists, the deductions to this. Their argument has been, and this is really, to me, a terrible argument. The argument has been that they're subsidizing state and local governments because we have high spending. Well, we have high real estate values. So yes, we have taxes, but we also have high real estate values. Other states, if you point out, actually get more money from us because what are we paying for? We're paying for rural broadband. We're paying for farm subsidies, and we're paying for disaster relief in other states that we're forced to pay for that we wouldn't want to pay for. So every state has to pay for everybody. It's not like this is a zero-sum game. And an attack on the real estate industry is probably the worst thing to do. And that's what I personally, and I think our association views this as an attack on the real estate industry. And an unhealthy real estate market, you don't want anywhere. So from our estimates, we're going to only have about, their estimate's 5 to 8%, so I'll round it off. I like round numbers, they go better in my head. 5 to 10% only about are going to itemize. Most tax filers right now don't itemize anyway, but this is going to be even less so. So the idea that home ownership is now not quote unquote the investment it was now before. I think that's a big problem. Home ownership before was looked on as a great investment. Now, if you ask anyone the next day, they'll probably say, well, maybe I'll rent for a few more years. You know, I think people move, yes, they buy homes absolutely because of lifestyle. They buy them absolutely because of lifestyle. But in New York, we depend on these deductions. And it's not just because of high taxes. It's also because real estate values are higher. Remember, and I tell this to people all the time, I could be making 80 or 90 grand in New York, which is nothing after taxes, compared to if you were making 50 or 60 in Montana or Kansas, where prices have plummeted, where housing is cheap. So it's important to remember this. So I strongly urge you to call your congressman. If you know people in other states, urge them to reinstate these deductions. Because this happened before. We had tax reform in '86, and then we have a man testified, and I'll wrap it up because I could talk for a long time. There was a man, a real estate developer by the name of Donald Trump, who in 1990-91 testified before the Housing Congressional Committees and blasted everybody for getting rid of tax deductions for developers and said they needed that. And then they reinstated that under President Bush. So, thank you.
You know, listening to experts like Mr. Weiden kind of confirms my own education as an urban economist. And in terms of timing, you really hit a responsive chord. That this, in economic cycles, this is not the optimum time to have such a stimulus. You want it when the country really needs a stimulus, like 2008, 2009. Anyway, thank you, Philip.
Thank you.
Our next, fortunately, we've got our last two speakers are CPAs, who probably have the driest delivery of them all. I'm going to ask John Unterreiner of Marks, Paneth. I keep on want to say Marks, Paneth, and Schromm because I remember the commercials. But anyway, and they kept the name. And John's been a long-time member, and he'll discuss some of the implications of the tax law as he sees it. John?
Thank you. Yeah, I'd just like to take over from, I guess, where everybody else has started. So I'll look to go into items that we can talk about a little more. Of course, I might have a drier approach, like you said. Tax simplification, no way. We didn't get a simple bill here. We were supposed to go from 7 rates to 3 rates. We didn't get that. You know, now we're still at 7 rates. We got lower tax rates, which helped a little bit of everyone. But of course, we lost all our itemized deductions. This last bill was complicated since there was no input from the tax professionals or the hearings that they were supposed to do like they usually do with these type of bills. One thing that they got rid of, I mean, not getting rid of, but they changed a little bit was AMT. AMT, the exemption was increased, and the phase out now starts at $1 million for married filing jointly. So that kind of took care of that, especially with also the itemized deduction loss of the state deductions and real estate being limited to $10,000. The child tax credit was increased, which is a positive effect. People started getting $2,000 per qualifying child under the age of 17. The income level, which is phased out now, $400,000 for a married filing jointly person. Another tax changes of the Affordable Care Act mandate was repealed for 2019, still in effect in 2018. The estate and gift tax had increased exemptions, and the medical expense threshold was reduced back to 7.5% for 2 years. One of the big changes that went through was the pass-through deduction, which is a big thing to talk about. It's effective January 1st, 2018. It's a new deduction for individual estates and trusts of generally the lesser of 20% of the combined qualified business income or 20% of the combined taxable income reduced by any taxable capital gain. Combined business qualified income is defined as the sum of qualified REIT dividends, qualified publicly traded partnerships, and qualified trade or business of partnership, S corp, or sole proprietorship. Triple net leases do not qualify for this deduction. Anybody that's 315 or lower of taxable income will get that not subject to certain calculations. So they'll get 20%. But if they're over that, then you gotta go through another complicated calculation, which is the play, a lot of different plays are gonna come about because of this. So there's gonna be 50% of trader business wages. It's the greater deduction to be limited to the greater of 50% of trader business wages, or 25% of and plus 2.5 of the unadjusted basis of all depreciated qualified property at the time of acquisition. Now that's saying a lot, because what does that mean? What's the definition of all those things? Depreciated qualified property, which is depreciated within 10 years or still being depreciated. So if you have property that's still being depreciated, like a building, that would still qualify. But if you have a building that's depreciated 11 years ago, and it was fully depreciated, you wouldn't get that in the calculation. So it goes by the cost basis. Reasonable comp studies will come into play with S-corps and partnership agreement changes for taking out guaranteed payments. The reason why this is going to come into effect is everybody's going to need the W-2 wages to be a component of this calculation if you're in a high category. So you got to think about how to lower or raise the compensation of the S-corp owners, and also guaranteed payments will not count as QBI income, so that won't be subject to getting you the 20% deduction, which is key. So people are going to think about, changing partnership agreements, etc. There are certain businesses where, like the fields of health, law, consultants, athletics, financial services, brokerage, and there's also catch-all provision. For all those businesses, there's a phase out between 315 and 415 of HGAR. So, and then once you go over that, you don't get any deduction. So they hit hard on those service companies, just so you realize that. Also, they're going to have a limit on net active losses. So if you have net active losses, say you have $1 million in your LLC of income, and you have $1.6 million in another LLC of active income, you're only going to get $500,000 loss to use against your other income. So that $100,000 is going to become a net operating loss, and it's going to carry forward. But just keep that in mind, because that's an interesting change in the law. We all know that the corporate tax rates went to a flat rate of 21%, which the only people who are going to get hurt in that probably are the 0 to 50,000 category, which used to be 15%, are now going to be at 21%. So that's going to hurt the smaller corporations. Section 179s have been increased to $1 million from 520, and they also went to 100% bonus. It's like a bonus depreciation, which will apply, to all the way up to 2022, and then it starts reducing 20% a year after that. Other negative ideas for businesses will be they disallowed deductions for entertainment expenses. They expanded, they used to have, if you had meals in your office place, they used to be 100%, now they're 50%. And they also deny a deduction for employee transportation. However, they don't include it in the income of the employee. They also eliminate deduction for transportation expenses that are the equivalent of commuting for employees, except if it's in the benefit of the employee's safety. They'll allow for that. So that's basically what I got.
Our final speaker is Jonathan Shalik, Shalik Morris, a CPA firm. We had the pleasure of having one of Shalik Morris's finest, Peter Scala, our CPA, has been a great service to us at the Builders Institute over the years. Many of you on the Finance Committee and BNI Board of Trustees know Peter. Jonathan, I guess, is going to be playing cleanup. And we'll cover all the boring points that we haven't heard so far. But seriously, even as I listen to this, and I've learned a lot from all the speakers, it's really kind of a daunting task no matter what hat you wear, and many of you wear multiple hats here, real estate investors, landlords, homeowners, commercial real estate developers. So the tentacles of this, I think maybe one could say that we maybe covered many of the major ones, but still it's going to be a daunting task to kind of make sense of this in the coming months, as this would be the first year where these rules will be applied. So anyway, I have to say, I didn't get a chance to talk about some of the backgrounds, but Jonathan has a degree in urban land economics, which of course is very dear to my heart, from the University of Wisconsin-Madison, which is very dear to several of us in the audience here. So anyway, Jonathan, without further ado, why don't you play cleanup and try to enliven it up a little bit.
I'm very happy to be the third accountant to be speaking. I guess some of what I'm going to say is a little bit repetitive, but I'll keep it short. But I think what the new law allows for is some opportunities for some tax planning for people, particularly with entity selection. We talked about the pass-through concept, where they're trying to, I think, in Congress, whether you like the law or not, they're trying to encourage, I think, people to sell things. And I think they're trying to encourage people to employ people, companies to employ people. So the pass-through deduction is beneficial to people who have S Corps and LLCs owners to the extent that the income that you generate is from selling things, not from services, broadly speaking. And so if you have profits flowing through to you from your S Corp or your LLC, then those profits could be subject to not being taxed on your personal return. So potentially 20% of those profits could be exempt from federal tax, subject to limitations, and one of the limitations is 50% of your W-2 wages. So if you have $1 million profit but $500,000 of W-2 wages, then only $250,000 of your profit could be subject to 20% of it not being taxed on your personal return. So there's opportunities in planning in terms of the entity selection and in terms of how how much salary you have versus how much profit that you have, the concept of reasonable salary for S Corp owners. And so that's one of the things to think about is planning, thinking through for 2018 how the law could benefit you depending on the type of business you have. This hasn't been fleshed out yet, but there are some companies that, as a single company, sell services and sell things. And there are some thoughts that maybe those two companies get separated so that the company that sells things might have income that is subject to this pass-through deduction, whereas the services might not be because you might have too high an income level. So that's one area that planning could be effective. As it relates to real estate, I have a handful of clients who are New York City residents who are probably going to get hit pretty hard by this law due to the elimination of the state and local, or the capping of the state and local tax deduction, because in addition to New York State taxes, you have New York City taxes to contend with. So I have a lot of clients who live in the city, who own in the city, who are actively talking about moving out of the city. And I have some real estate broker clients who, in terms of forecasting their 2018 income, when we're talking about projecting, and it's a little early for that, they're telling me that they think there's going to be a lot more activity on the rental side, like some of the speakers have already spoken about, as compared to in the past because of some of the losses and some of the benefits of owning. I have some real estate clients who they get something called carried interest, which you might have heard a lot about in the campaign. And what that means is that you and I, when we get paid for doing something, we pay ordinary income tax rates when we get that income. The concept of carried interest is that as a sponsor of a real estate investment, you can participate, your share of the income can be based upon performance. So you can say, if we're in the business of selling things at a capital gain, my income will only come, or most of it will come, when we sell this, and my income will be in the form of a percentage of the gain. And normally you would think, hey, I worked for that, so why isn't that ordinary income? But the tax law allows you to treat that participation, based on rules of broad brush stroking, as capital gain subject to long-term rates. So that affects hedge funds, that affects people in the real estate industry who are sponsors of investments that generate capital gains. And so now it used to be a 1-year hold period where you can get that long-term treatment. Now it's a 3-year hold period. So I have certain clients now where it's affecting them now. They're in the middle of raising money to do certain real estate investments where they're structuring their participation to come in the 3rd year and maybe factoring in, because they would have gotten it sooner, maybe they're going to factor in an interest or a growth component. If they would have made 20% on the participation, maybe not now to 25%. So that's a real estate, real world implication as to how this law is affecting my real estate clients. And I think that's, everything else was very well covered. So hopefully I livened it up a little bit with those few items. So thank you very much.
A few years ago, I was visiting relatives in Italy and I was having trouble sleeping one evening, so somebody gave me the Italian tax code to read. I thought the 9,249 pages of the tax code was difficult enough, and I don't even speak or read the language, but this seems to take the cake. We have time for some questions. Any questions? Yes, Gene. Try to be optimistic.
This is looking for information. What do you think is going to be the net effect of the sale of real estate in one-family houses, for instance? Do you think that the price of real estate is going to now drop? Or do you think there won't be any effect? What does this panel expect?
For those of you who didn't hear the question, Gene's question, what do our panelists think about the effect of the sale of real estate, residential real estate? Is the price going to go down? So do we have anybody?
So everybody has different variations. To be honest, the answer depends on who you ask. It depends where. Our economists at NAR estimate that it could be anywhere from 10 to 20%, depending on where the area is down, because in terms of the values. On the positive, if you want to look at it to be try and find the positive is, if values plummet, new buyers could come in and buy up houses. So if you want to look at it that way, sure, you could have new home sales, but a lot of people, I think, are going to lose their equity that they've built up, just at the time that a lot of their values have come back to what they were 10 or 15 years ago.
Just stand up, identify yourself. Oh, yes, we have. By the way, for some reason, I don't know, we only have one mic, so you sure? Can you?
I have enough time. I want to respectfully dissent. Very respectfully. I think it's very possible that that's the case. I think that it'll be case specific.
Oh, okay. Interesting. I think you can project that.
I think it'll be case specific. I think on its face it seems like the real estate market should go backwards a little bit because you're losing these deductions and the benefits of home ownership goes backwards. I think once things adjust themselves, whatever that is, I think it'll move back in the positive direction again. I think in certain areas, for some of my clients, it's funny, for the high net worth people, this law annoys them more than it affects them. Because they're not going to stop living their life, going to dinner, going on vacation, or buying things that are expensive because they have to pay $100,000 more in taxes because of this tax law, or $50,000 more. So I think a lot of people are well-to-do and they'll figure out a way to get by and adjust. I think in some areas, I think in the higher priced areas, it might hold up a little bit better than not, because the wealthier people, I think, are a little bit more insulated and might even be benefiting from this tax law in some ways. Their stock portfolios are going up, so there's a little bit of an offset to that. I do think generally there will be a little bit of a fallback in the market. I don't think it'll be 20%, but I just think it'll be a little bit more modest before it picks back up again.
All right,
I'm
so-
not an accountant, so I'm just.
Right.
That makes, just add a comment.
George.
Yeah, from a financial planning perspective, and I think what you're saying is right in terms of the high net worth folks, they're going to gripe about it, but they're not going to change their lifestyle. But, if you look at real estate over long periods of time, single family homes, it's based on affordability. So I think that, there are going to be pockets and segments of the market where people are going to be affected and the price will reflect the affordability. So I think, people will figure out, and, maybe I can't afford an $800,000 home, but now I can do a $600,000 home. Does the 800 go to 600? I don't know. Or does the 600 go to 650 because it's become more popular? But I think it's going to be sort of segment and individual specific as far as it. I think it's hard to paint all of residential real estate.
We had a question here, and then Barry, I think you had a question.
My question was answered.
Your question was answered.
Yes, thank you.
Don't you want to have another question?
I will have another.
Barry.
Yes, I think generally speaking, in terms of real estate values here in this immediate Hudson Valley area, the Hudson Gateway Association of Realtors really feels that this measure, as Phil said, will impact us negatively. We see a lot of young buyers who are coming into the market, and I think as a result of this measure, we may see less of the young millennials who are currently looking more for rentals. If you look at the rentals that are going up here in White Plains and the developments that are going on in Yonkers and New Rochelle and the larger cities, those are mainly rental units because the young people are not interested at this point in buying. And I think this bill and these tax measures are going to even cause a further deterrent toward their interest in buying property. So I think I have to agree with Phil that it may impact us negatively. For someone who's very involved in the co-op market, I know many of the people in the room here are involved in selling co-ops. I think it'll affect more the Manhattan market in terms of the co-op value because the values are so high. But I have to tell you, as an active realtor, one of the questions that buyers frequently ask is, what is the deductibility? Okay, and the deductibility is not only the interest on the underlying mortgage, right, Mindy?
Absolutely.
On the underlying mortgage, but it's also the interest that is paid in state and local taxes. So I think to a lesser degree, that is still a question that buyers will ask in terms of the co-ops.
I will, sure. One of the first questions a lot of young home buyers do is they ask us to do a tax projection as to what the increase in their take-home pay might be given the tax effects of the purchase of a home. I know my son and daughter-in-law went through this not too long ago, and basically when I told them that basically they'd have another $5,000 to $10,000 a year based on certain parameters, it made the difference for them of feeling more comfortable in making the investment in the home because they knew that it was going to be more than they were paying in rent, but because of the tax deductibility of the things they were going to be investing in, their take-home would be higher and they could afford it. So while I agree that it might not affect the high net worth individual, I do think it's going to have an effect on the $500,000, $600,000 home, especially for the young home buyer. I think you will find more of them staying longer in rental properties until the size of their family is such that it really becomes untenable. But I think that is going to be hesitation on their part.
One more right of the apple.
Yeah, I also wanted to add that when I say 10, 20%, 5% decline, obviously it's not all equal. So for instance, when you had these massive foreclosures going on from 2008 to whatever year you want to say before the market started recovering, not every house was in foreclosure, but the cumulative effect reduces the value of your home. So if you see all these values start a little by little, maybe the house down the block went down 20%, your house could go down 6%. Whereas your house might have not gone down at all if that didn't happen. So it's the cumulative effect on everybody, not just one value.
Any other questions? Yes.
Hi. So this tax also affects summer houses because you might have two deductions, one from your house and one in the summer house. At the same time, the taxes on the property house that you live in and
So your question concerns how the new laws affect the summer houses or vacation homes, essentially.
yes, vacation homes, so means that you have the two houses that will be limited to the 10,000 still.
Anybody want?
Yeah.
So basically, under current law, you could take an interest deduction on 2 properties, but you could take a real estate deduction on as many properties as you owned. So therefore, the second housing market is going to be affected as well, because you won't be able to take the real estate tax deductions on that second home, unless, of course, you turn it into a rental property, and then it will make, difference. So I think you're going to find that people who only occasionally use their rental properties are going to look more now towards, not their rental, their second homes. They're going to start looking towards renting those homes, not so much because they need the income, but because they'll get a much better tax advantage by turning it into a rental property.
All right, anybody else? Anybody else? Before I give the final thank you to our panelists, I do want to thank you all for coming tonight. I'm going to ask our panelists right after we adjourn to stay here. We'll have a group picture. I would ask Vince Unterreiner, our president, to come up and join us for a group picture. Ken Finger, I ask you to come up to join us with the group picture. And so I want to thank you all and thank our panelists. And anybody who didn't get a parking sticker, come right up and we'll take care of you. Stay home, everybody. Thank you.